What's up, everybody? Michael Silva here. Got an action-packed episode today. Nothing to worry about at all with all this green on the board, just smooth sailing up ahead. So we need to talk about potential levels in the S&P 500 and the warning signs that are taking place in building here, very similar to back then in 2011. We got a lot to talk about on today's stock market brief, but I'm going to keep it quick and to the point, so hit that thumbs up if you haven't done so already. It's greatly appreciated. Let's get into it. Alrighty, everybody, welcome back to the show. Now, I want to first show the calendar. What's taking place this week that we should be aware of? Tomorrow, we have some Fed talk going on, but the big report's coming there on Friday. Understand that we did see a very nice day in the markets, but guess what? You got to pay attention to the dates. Right now, it's March 29th. This is almost coming into the end of quarter, so we could be seeing what's known as month-end markup taking place. That is a possibility. And it means it can go potentially higher. Now, where can we potentially map out our levels? Well, today, take a look here. We got outside of those anchored VWAPs that we were discussing on the prior episode. It didn't even allow for the cash market session to try to break through it. So the overnight session took us there right out of the gate, and we back tested and started moving higher. I went ahead and applied a volume shelf profile to the high of this date to give us an idea of where volume traded. And as you can see, we're kind of breaking this area here, and if that holds, it opens the door to kind of get through this volume window pocket to this potential next level that we can watch for next resistance, which would be roughly around 410. Now, it might not be a straight shot there, and there's ways to manage risk. One way is to be like, okay, if we get back below the year-to-date anchored VWAP, or even back below today's daily price and close there, I'm going to get out of the position. But I'm going to be long here and try to play it to 410. And if I get stopped out, what does that equal? Well, it means that you're playing this for the risk, this for the possibility of reward, which is actually a pretty strong risk to reward trade. Now, we're not too far off the weekly expected move. You can see we're starting to break out of this descending broadening wedge pattern. Saw a little bit of an uptick in volume, so it's positive overall. A very important level to watch, similar to how we just pointed out here on 410. I'm going to show you here Bookmap. This is some incredible software. Bookmap team offers my subscribers a discount with the pinned comment down below. Take a look at that if you haven't already. This allows you to see order book on the screen. So if you're an intraday trader and you're looking for levels of potential resistance and support, this software is legit. So as I'm showing you dating back to March 27th, so the start of the week, and I wanted to call out 4,100 level here. That is a pretty high level liquidity, and these levels can potentially act like magnets, sucking price up, and the longer it's there, the more they expect this order to get filled. And you can see price has been kind of dragging into this area, so it'd be very interesting to watch to see if price can pull up into that area in coming days, potentially the next week. And roughly speaking, if I looked at the daily candlestick chart of ES, that brings us to roughly around this same area here on the SPY, which it would get through this volume shelf and then, or volume kind of gap right there, back to this volume shelf over there. Now, a couple other things I want to call out is on the zones. This is something that I share with my Discord community on a daily basis. And you can see here, ES, the upper range is at where? It's at 40.99, so 4,100 right there too as well. So we have a couple areas of resistance confluence, this level of liquidity. We have the zones there. We have the SPY, right? This volume shelf profile over there too as well. We have a couple of things starting to light up red. What that tells me is the indicator itself, right? So you have high level, you have a low level, and then you have a midpoint. And then you have basically price that just trades within this area. And the closest it gets up here into this, and they're dynamic, they're constantly changing, this means that the range is going to start lighting up red, telling you that price is getting to the high end of this indicator. And you can see HYG is one of those that are lighting up red, and HYG is high yield. So that's something very important to pay attention to, because high yield and like the NASDAQ, they move very similarly. They have a strong correlation with one another. SPY is getting up to the higher end. The Dow Jones Industrial Average is moving up there too. So a couple of different ones lighting up. Another thing that I want to call out is while those are moving to the higher ends of their zones, you're starting to see volatility come down too, which we discussed. NASDAQ volatility just yesterday. It gapped down, right? It came down today and then didn't close at the highs. It closed more near around the high of day for this volatility. And you can see the low end is at 20. 23.25 now, where the close was at 23.99. If we take a look at the 15-minute time frame, I just wanted to show you the daily expected move from yesterday that we pulled out, but how it traded today. We actually gapped through that level out of the gate. Okay, so we started above the daily expected move, but take a look here how it acted when it came back into that level. It started acting kind of as like a flip the switch, and then we started moving from that point, acting as a level of support. So if we go into tomorrow's daily expected move, you're starting to look up here at 404.40 at the high end, 398.30 at the high end. Now, I wouldn't necessarily chase a move to the upside as it stands right now, and I'll show you a couple of indicators why. But because we're above the week to date, because we're above the 5-day, that lets me know the bulls are in control. So if we do get some sort of pullback to the lower expected move, I'd be starting to look for price for a lower high to form, a lower low, boom, boom, and then I would be looking to buy off of these levels as it starts to clear one of those levels, and that would allow me to buy into this short-term trend if it actually were to hold, and it gives a good risk to reward by doing so. Now, the reason why I wouldn't want to chase this is because, well, look at the RSI, it's overbought and a negative divergence as price is moving higher. Same with the PMO there too as well. Okay, now I want to go into more risk. So we talked now about, hey, look at the market looks good up here. It looks like it's breaking out, but I want to show you this chart because big up days, they're typically surrounded by big down days too, and big down days are typically surrounded by big up days. That's what we call, volatility. And what I'm showing you here is the SPY chart dating way back to 1993, and I'm applying a 1-day rate of change. And it'll show you basically this is the 0 line, right, through the center, and if it goes above 0 and it comes up to here, 5, that means that's a 1-day move of 5%. And if it goes down here to this 5, it's a 1-day move down 5%. And what I want to call out here is during periods of a lot of volatility, so for example, bear markets, right? Boom, boom, boom. What do you start to see? Well, you start to see a series of a lot more higher highs, and they're surrounded by a lot of higher highs as far as the rate of change goes, and lower lows there on the rate of change as well. And you can start to see it expands out, right? And then same here, it's expanding out. So today we saw a big update in the Qs, decent update in the SPYs, and I just wanted to reiterate that, hey, don't get too much FOMO because there are going to be lots of opportunities within this type of volatility. Now, during periods where we see bull markets, so for example, coming out of the .com bust, what do you see the VIX doing? The VIX is down here. The VIX is usually down low. It's trending lower. Same with over here. Between this period coming out of 2012, the market started ripping and moving. Those were some of the biggest legs there in the market. Okay, so those large moves, you typically see the VIX lower. And here, during times of higher volatility, you can see what? You see much more chop, much more bigger moves up and down. And I want to reiterate this, I've shared it a few times, that you've got to think from a volatility adjusted, style when you're trading. So if you're here and you're like, hey, yeah, I traded this area right here, boom, and it was amazing, and I traded right here and boom, it was amazing. Understand that if you had a $100,000 portfolio in those periods, you're used to the VIX kind of going down. Okay, but what happens if your 100K portfolio comes into a period where you see double the VIX? Okay, all of a sudden now your 100K portfolio is moving up and down as if it was on a daily basis, as if it was 200K. The reason why is because you're seeing double the amount of volatility. So this allows you, by knowing this, it says, hey, we're in very, very volatile times. This allows me to be more aggressive, more tactical, and then swing trades, they potentially don't work as well. And we've been talking about that, but I wanted to reiterate that. Now, I want to show you like this period back here in 2000, going into 2011 to 2012, where we saw these volatility spikes and these higher rates of change. We are going into what's called the debt ceiling talks, right? The debt ceiling, you probably have been hearing about it, but in 2011, there was something called the debt ceiling crisis, okay? And what happened in the debt ceiling crisis? Well, if we zoom to 2011 to 2012, we had a lot of volatility in that time, and then within a 4-month span or so, we saw an 19% drop in the S&P 500 in the course of literally 3 3 to 5 months range right there. That big of a drop. So pretty aggressive. So what do we see that was taking place during that time that can maybe give us insight to be much more careful? Because like I said, the macro backdrop, it doesn't look good. Price action looks good, but we already know that we see big up days and big down days to each other. Take a look here at the 5-year CDS. Credit default swaps. This is right now from February. We're starting to see this rise as a lot of banks collapsed, right? And now what's interesting is if you look back to the left of the screen, this is right over here is 2009, and back over here, excuse me, was 2011. Okay? Now, what's interesting here, we haven't seen it this high since that period in time. During the into 2011 and into July, where we're going into those debt ceiling talks, they were on the rise, okay? They were on the rise. So this was July here when it peaked out. If I go back to this chart, okay, this is July right here, and that was roughly about the start of this big decline over there. So this isn't at 2011 levels, but this might be something to watch, that if it keeps continuing to climb as we're going into the debt ceiling talks and debates, this could be very dangerous, and it could be giving us insight as to saying, hey, let your foot off the gas because those big down days may be around the corner. So that's all I got for you on today's episode, everybody. We talked about bullish areas, bullish levels to watch because price action is looking good as it stands, but the macro backdrop right now, it just does not look good, so we need to remain on guard. That's all I got for you. See you later.